$38.43 trillion debt crisis triggers inflation. Inflation destroys purchasing power. But here's what silver stackers understand that economists don't. When government spending explodes through massive debt financing, industrial metals become monetary metals. Every solar panel, electric vehicle, and data center built with debt-financed stimulus requires silver. The debt bomb doesn't destroy silver demand, it detonates it. I'm not a financial advisor. This isn't financial advice. This is pattern recognition based on industrial consumption data that shows exactly why America's debt crisis creates the perfect storm for silver prices. By the end of this video, you'll understand why $38 trillion in government debt makes silver the most undervalued asset in the global economy. Let me show you the numbers that prove debt-fueled spending drives silver demand exponentially. Silver industrial demand hit record highs in 2025, consuming over 700 million ounces annually. But here's what makes this different from every previous commodity cycle. Industrial consumption now represents 59% of total silver demand, up from 50% just a decade ago. This isn't gradual portfolio rebalancing. This is systematic transformation of silver from precious metal to strategic industrial commodity. And debt-financed government spending is the primary catalyst driving this transformation. Here's what I discovered that changes everything about silver investing. Government infrastructure spending does not just create economic stimulus, it creates massive silver consumption that can't be turned off. The European Union's Green Deal targets 55% emissions reduction by 2030, driving unprecedented investment in renewables and electric vehicles. India's production-linked incentive scheme aims to add 25 gigawatts of solar manufacturing capacity by 2026. U.S. infrastructure bills allocate billions toward expanding EV charging networks and upgrading electrical grids. Every dollar of debt-financed green spending requires silver consumption. And unlike financial assets that can be created infinitely, physical silver exists in finite quantities that must be mined from the ground. But here's where it gets absolutely explosive for silver investors. Industrial silver demand is completely inelastic, meaning it doesn't decrease when prices rise. Solar panel manufacturers can't substitute copper for silver without destroying efficiency. Electric vehicle producers can't eliminate silver from battery management systems without compromising safety. Data center operators can't replace silver in critical electrical contacts without risking system failures. The Silver Institute's latest report, Silver the Next Generation Metal, confirms that silver remains essential across multiple high-growth sectors as industries race to embrace digital innovation and meet clean energy mandates. When debt-financed spending drives industrial demand for irreplaceable materials, prices don't rise gradually, they explode violently. Here's the mathematical proof that America's debt crisis creates silver price acceleration. Global solar photovoltaic capacity is forecast to reach 665 gigawatts in 2026, supporting approximately 120 to 125 million ounces of silver demand from solar panels alone. Electric vehicle production, forecast at 14 to 15 million units, is expected to add another 70 to 75 million ounces. Grid upgrades and data center infrastructure contribute an additional 15 to 20 million ounces. That's over 200 million ounces of annual industrial silver consumption from debt-financed infrastructure spending. And this represents only current government programs, before Trump's proposed $1.5 trillion defense budget and additional infrastructure initiatives. But here's what should terrify silver shorts and excite silver investors. Supply cannot respond to demand acceleration. Over 70% of silver production comes as a byproduct of other metals mining. You can't simply increase silver production by opening new silver mines. Silver supply depends on copper, lead, zinc, and gold mining economics that operate on completely different market dynamics. Silver mine production increased only 2% in 2024, reaching 844 million ounces. Meanwhile, industrial demand exploded by 7% to 700 million ounces. The structural deficit reached 117.6 million ounces in 2025 and is projected to widen further as debt-financed infrastructure spending accelerates. And here's the part that makes this the perfect wealth preservation strategy during debt-driven inflation. Silver benefits from both monetary debasement and industrial demand acceleration simultaneously. When governments print money to finance spending, fiat currencies lose purchasing power. Investors flee to hard assets with intrinsic value. Silver qualifies as both monetary metal and industrial commodity, capturing capital flows from both monetary debasement and industrial consumption growth. China's recent export restrictions on refined silver prove that major powers understand silver's strategic importance. Starting January 1st, 2026, only large, state-approved Chinese companies can export silver, and only after obtaining special government licenses. China controls 60 to 70% of global refined silver supply. Export restrictions create instant global supply shock, while China secures domestic industrial advantage for their own green energy transition. This is economic warfare, using industrial materials as weapons, and silver sits at the center of this conflict. Let me show you exactly how debt-driven inflation makes silver the ultimate hedge against currency debasement. $1.22 trillion in annual interest payments represents direct money creation that enters the economy without producing goods or services. This is pure inflationary pressure that reduces the purchasing power of every dollar in circulation. But silver consumption produces tangible economic value through solar energy generation, electric vehicle efficiency, and data center functionality. When government creates money without production, while silver supports actual production, silver becomes more valuable relative to debased currency. The mathematics are undeniable. Rising government debt creates inflation. Inflation drives investors toward hard assets. Silver offers dual protection as both monetary hedge and industrial consumption growth story. And the consumption growth story is entering exponential acceleration phase. Solar photovoltaic installations are projected to reach 1,735 gigawatts of global capacity by 2028. Electric vehicle production is expected to grow from 12 million units annually to 35 million units by 2031. Data center electricity consumption approaches 1,000 terawatt hours annually by 2026. Each solar panel requires approximately 20 grams of silver for conductive efficiency. Each electric vehicle uses 25 to 50 grams of silver in sensors, wiring, and power modules. Each data center requires silver in electrical contacts, switches, and precision electronic components. The convergence of debt-financed green spending with inelastic industrial demand creates what commodity analysts call a perfect storm scenario for silver prices. But here's what makes this different from previous precious metals rallies driven primarily by monetary policy. This cycle combines monetary debasement with genuine industrial consumption that cannot be satisfied through paper contracts or financial derivatives. You cannot power a solar panel with a silver ETF. You cannot manufacture an electric vehicle battery with paper silver certificates. You cannot operate a data center with promises to deliver silver sometime in the future. Industrial demand requires physical metal delivery, which drains available supply from investment markets and creates increasingly tight physical markets. COMEX registered silver inventories have fallen dramatically while industrial consumption accelerated. London Metal Exchange, silver stocks show similar depletion patterns. ETF holdings face redemption pressure as industrial users compete for available supplies. When industrial demand competes directly with investment demand for limited physical supplies, prices enter vertical acceleration phase that traditional market analysis cannot predict or contain. The University of New South Wales research indicates solar manufacturers will require over 20% of current annual silver supply by 2027. By 2050, solar panel production alone could consume 85 to 98% of current global silver reserves. This isn't demand growth. This is demand explosion that makes silver strategic national security priority for every major economy. And strategic materials don't trade at commodity prices. They trade at premium prices that reflect their essential role in national economic competitiveness. Here's exactly what the debt crisis means for silver investors over the next 24 months. Government debt service costs now exceed defense spending, forcing politicians to choose between paying creditors or funding critical programs. This creates powerful political pressure for monetary expansion to reduce real debt burdens through controlled inflation. Federal Reserve policy will prioritize debt sustainability over price stability, maintaining accommodative monetary conditions that support asset prices while devaluing currency purchasing power. Silver benefits from both sides of this policy dynamic. Monetary expansion drives investment demand, while debt-financed infrastructure spending drives industrial demand. The International Energy Agency estimates that by 2030, solar and EV sectors alone will consume half of global silver output, leaving minimal supply for jewelry, coins, and investment bars. Unlike copper or aluminum, silver has no viable industrial substitute. Its unique conductivity and reflectivity make it irreplaceable in high-performance technologies essential to modern economic infrastructure. This means industrial demand becomes increasingly price inelastic as silver transitions from optional component to mission-critical material for technologies that governments consider essential to national competitiveness. When mission-critical materials face structural supply deficits, governments typically implement strategic stockpiling programs that remove additional supplies from commercial markets. The U.S. government included silver on its critical minerals list in 2025, recognizing its strategic importance for economic security. This classification justifies government stockpiling and supply chain security measures that could dramatically impact commercial silver availability. China's export restrictions represent the beginning of resource nationalism applied to strategic materials. Other producing countries may implement similar policies to secure domestic advantage in green energy transition technologies. Resource nationalism, combined with structural supply deficits and exploding industrial demand, creates the perfect conditions for commodity price dislocation that overwhelms traditional market mechanisms. Silver enters 2026 with unprecedented fundamentals. Record consumption, supply deficits, and strategic classification create explosive potential. The mathematical certainty. Debt-financed infrastructure requires massive silver consumption that cannot be substituted through paper markets. When $38 trillion drives spending while supply remains constrained, the outcome is arithmetic, not speculation. This is how debt bombs explode. Infinite money meets finite materials. The greatest wealth transfer in history occurs when industrial metals become monetary alternatives during currency collapse. Silver sits at the intersection of debt crisis and industrial revolution. When governments create infinite money to fund finite material consumption, prices explode beyond traditional analysis. You're witnessing silver's transformation into the ultimate debt hedge, essential material that cannot be printed.